Government Employees Pension Fund. Decisions, and more decisions about my retirement. I want to exit, but what are my options? So now we go to the slide, and if one follows the slide in a clockwise direction, starting at 1 o'clock. I want to exit, but what are the options? Yes, I will receive a lump sum, but what taxes will I pay? What about my debts and commitments? Who will be my financial advisor? How will my retirement money be invested? Will my investments be split between a certain portion of the capital to give me monthly income to meet my monthly lifestyle expenses, while the rest of the capital to generate wealth for me to protect me from inflation? Who will drop my will or form a trust if it's necessary? Continue to manage my investments during retirement so that I may enjoy a stress-free retirement. Who will ensure that upon the death of my death, that my family will ultimately receive my hard-earned money? We at Garage Corporation will do all of this for you. We at Garage Corporation are a multidisciplinary financial and fiduciary advisory services firm with offices in KwaZulu-Natal as well as in Gauteng. Now to introduce both the firm and myself. I am Professor Dilip Garage, the CEO of Garage Corporation, a financial and fiduciary consultancy practice comprising chartered accountants, lawyers, tax consultants, and certified financial planners. I am a chartered accountant and a certified financial planner. I have held professorial positions at various universities. I was the South African Financial Planner of the Year in 2004, an award given by the Financial Planning Institute of Southern Africa. I have been advising GEPF members on retirement planning for 35 years. I served as director on government and commercial boards. I am a financial coach to high net worth families. Before we actually go into the presentation itself, just some introductory remarks. The presentation is relevant to government employees. And who are these people? They include, amongst others, educators, health professionals, police, defense, Navy, South African Revenue Service, Auditor General, the Judiciary, and so on. So it's a very large spectrum of people who are, in fact, contributors to the Government Employees Pension Fund. The presentation will assist those over the age of 55 who belong to the Government Employees Pension Fund, commonly known as the GEPF. Members are eligible to exit from the GEPF, normal retirement age 60, but they may exit at any time between the ages of 55 and 65 years. Early retirement 55 with penalty, and some may continue up to the age of 65. Those who choose to retire after 60 years, no penalty is imposed. It is important to note that if you were a member of the GEPF prior to the 1st March 1998, then the pension balance accumulated up to 1 March 1998 is tax-free, and the lump sum accrued up to that date can be paid to you tax-free. So it does come into the calculation when you retire. The GEPF has 1.3 million members, and it is the largest retirement fund in South Africa. It is a pension fund and not a provident fund. This means that upon retirement, you will draw a certain lump sum, which for most people, it equates to around 28% of the value of your retirement in cash. And the remainder of approximately 72% of your retirement fund must be reinvested in the GEPF to give you monthly retirement income for the rest of your life and your spouse's life. In majority instances, upon the death of both spouses, the pension falls away, which means that 72% of your retirement remains in the GEPF and your children then lose out. Here certainly lies an inherent weakness, or call it a flaw in the GEPF. Your hard-earned money lost to the fund, and your family is the loser. Surely there must be a way around saving the 72%. Yes, there is a way. Listen carefully. If you resign from the fund, you're allowed to take the full lump sum of 100% of your retirement fund for you to keep and for your family. I think this is very important. There are obviously challenges in this method of resigning, but you can overcome these challenges with careful planning on your part. It is perhaps useful to point out at this juncture the 72% retirement capital, which is your retirement fund, is under the control of the GEPF. The GEPF hands your money to the PIC, who? Public Investment Corporation. I'm sure you've heard of the Public Investment Corporation, who have approximately 2.7 trillion rand of investments. You unfortunately have no say on how the money is being invested, and that can be of concern because between you and your spouse, you want the 72% capital, which is meant to give you monthly income to last between 20 and 30 years into the golden years of your retirement, to be there for you. You don't want to be left destitute in the golden years of your retirement. So you have no say over the 72% of your retirement money is surely of concern. The two matters: no control over how the 72% of your retirement capital is invested for your golden years into retirement, and the loss of the 72% of your retirement capital upon the death of you and your spouse is surely of concern. Then what are your options? Well, instead of retiring, you may resign from the GEPF, take 100% of your retirement capital away from the GEPF. At least upon death of both spouses, the remainder capital is left to your family, and you have a say in how the money will be invested. Yes, you can do that, and you have addressed the two concerns, namely the control of the capital and the loss of the capital. But it comes with its challenges. You may end up paying a lot more tax when you resign. But how can you avoid paying a lot of tax? Yes, listen carefully again. I will show you how. In the presentation, you will learn that we at Garage Corporation are tax specialists and independent financial advisors with brokerage contracts with all insurance companies and most reputable financial institutions to advise you on exactly what is best for you. Is retirement or resignation from the GEPF? It has to be personalized. It's not about one plan fits all. We will show you a technique of resigning from the GEPF and moving 100% of your retirement to a tax-free vehicle called the Preservation Fund, and work a plan from there. The plan must suit your needs, and this is what we do best at Garage Corporation. You complete a retirement planning questionnaire. We prepare a financial planning report to help you to retire comfortably with stress-free lifestyle during your retirement. But we are not saying that you must resign and take all your money out. If the circumstances suit you and your health is good, it may be better for you to retire rather than resign. We will discuss which option you should rather opt for. Will it be retirement rather than resignation? There are certainly benefits in retiring from the fund. You must look at the benefits and also look at the challenges or the so-called pros and cons before deciding whether to retire or to resign from the fund. If you resign, where do you invest your funds? There are options. Your funds are split into two parts. The one part is a tax-free lump sum, which may make up more than 50% of your resignation capital, whilst the other portion is the taxable lump sum. Both parts must be invested in a way to give you maximum growth with the least amount of tax, so that the capital can be stretched both for you and your spouse's lifetime and thereafter be left for your children. But most important of all, you must have sufficient income to lead a comfortable life during retirement. Enjoy your hard-earned money during retirement. So let's go into the presentation now and we will show you exactly what you need to do. The content of the presentation, there's some important terminology and concepts we need to look at. What are the payouts when you retire? We will then look at a real life situation of a benefit statement. So in other words, of an individual who is planning to retire from the fund, the factors to consider before a decision to retire or to resign from the GEPF that you have to consider, tax implications of retirement fund payouts, who is a spouse for the purposes of the retirement fund, what inflationary increases are handed out by the GEPF each year, when do you choose retirement instead of resignation, what happens in the event of divorce, the medical aid subsidy, who qualifies for it post-retirement. When you resign, you go into a life or a living annuity. What is a life versus a living annuity, and how does it help you to generate income and perhaps create wealth for you? Retirement advice, who is going to help you to retire? And there are some frequently asked questions which we will cover, and you may have other questions which you may wish to ask. So important terminology and concepts. What is a final salary? It is the average salary over the last 24 months of pensionable service. What determines your level of benefits? It's normally your final salary together with or multiplied by the years of pensionable service will determine what your final level of benefits are. Is a benefit value net of tax? No. All the values are calculated before tax. Are retirement and resignation benefits taxable? Yes, both the lump sum and the monthly income is taxable. So tax is paramount. It plays quite an important role, and we at Garage Corporation focus heavily on the tax aspects of the GEPF. The retirement payouts, there are two payouts that are normally made. One is made by the employer, the other made by the GEPF, which is the retirement fund. As far as the employer amount is concerned, that is your accumulated leave pay. That is normally taxable, and it is taxable at your marginal rate, which is a higher rate that is applicable to your accumulated leave pay that you will receive as a lump sum. As far as your retirement fund is concerned, you'll receive two forms of payouts. You'll get a lump sum, and once when the lump sum is established, put away, you will also get a monthly pension going forward. And let's look at the lump sum first. The lump sum is taxable. The first 550,000 upon retirement is tax-free. However, I draw your attention to the very last point that says the tax-free 550,000 is boosted by the pre-1998 tax-free, which means that the 550,000 plus any amount that accumulated before the 1st of March 1998 becomes your total tax-free amount. Whatever is then left over will certainly be taxable. It is taxable in terms of special tax tables that apply. It's called the retirement tax tables. It is taxed between the rates of 18 to 36% on a sliding scale. So that is in respect of your lump sum. As far as your monthly pension going forward, it is treated as a salary and it is taxed at the marginal rate. Now, here's an example of a benefit statement, a real life situation of an individual who planned to retire. As you can see here clearly, the ones that are highlighted is the age of this particular employee of the GEPF. Age is 57, and you will note that the person is obviously hasn't reached the age of 60, so it's not normal retirement. It's early retirement, age 57. And you'll also note that this person's pensionable service date commenced the 1st of January 1989, which is prior to the 28th of February 1998. So therefore, this particular individual has a pre-98 tax-free amount of 900,000 as reflected in this particular slide. So if we go to page 2 and the relevant amounts are ringed in red, you find under normal retirement, which is taken, as you can see, along that same line, estimated to age 60. And that amount is calculated as though you're going to retire at age 60, and the monthly pension is computed as being 27,869. That is the amount you receive each month. In addition to that, you would get a lump sum payable of 1.234,717 rands. So clearly, this is taken to age 60. If this person wishes to retire, in this example, at the age of 57, this amount will then obviously be reduced by the penalty. And we'll discuss the penalty a little bit later, exactly what the penalty means. So that's the one option to retire. However, this person could also resign from the fund. And as you can see at the bottom of the slide, with resignation benefit is estimated, it's taken to age 57. In other words, taken to the current age, to the current date. And you can see the amount reflected there is 3.3 million. Now that is what I spoke about in my introductory remarks. You can walk away with a lump sum of 3.3 million. However, the tax penalty is pretty heavy, and we will discuss that in detail, how you can reduce the actual tax. So which is the better option? Is it better to retire or is it better to resign? If you retire, roughly 28% of the lump sum you'll get in the form of cash, and the 550,000 rule will apply in that instance, and the sliding scale to that particular lump sum per the tax table will apply, and you can then work out exactly what would be the tax implications for the cash lump sum. The remaining 72%, the GEPF buys you an annuity, and you will receive a monthly income for the rest of your life and your spouse's life, as discussed in the preliminary remarks. On the other hand, if you resign, you're allowed to take the full lump sum and find the best tax fit. So you would take the entire lump sum away from the GEPF, and you would then set aside part of the capital to give you monthly income, and the rest of the capital you'll invest it to grow for you to counter the effects of inflation. So let's look at the factors to consider whether you should retire or whether you should resign. I've painted two scenarios here, scenario one, scenario two. In scenario one, let us assume that if you are divorced and you don't have a spouse, and that you have financially independent children or you have no children at all. You plan to go overseas, your health is not very good, so it looks like you are the sole person who's going to be benefiting from the 72%, which is going to give you the monthly income. In that case, would it be better for you to retire or to resign? And clearly, I would be inclined to advise this person to resign from the fund. Why? Because 72% of your retirement benefits will be lost if, for example, you die and there's nobody else to really take advantage of the money that you've left, not even a spouse. So resignation in scenario one certainly makes sense. So in scenario two, if you're married and you have a spouse and there are minor children, South Africa is your permanent home, your health is good, perhaps one would be inclined to believe that you should be retiring from the fund. The reason being is that you would take your 28% of lump sum, the remaining 72% will then be an amount that will remain with the GEPF. And certainly in this instance, because your health is good, you would be able to buy life cover. Now, life cover is a lot cheaper than what you envisaged in the past, provided your health is good. Even if you're at the age of 60, you can go and scout around for life cover. And that is what we do best, being independent financial advisors and having contracts with all the insurance companies. We would try and get you the best rate, and we would then buy you life cover. So just to actually go back to my example, where you would retire and receive the lump sum of 1.2 million rand, roughly, and you would obviously, if you were to die, then remember that you would be the loser, because in the resignation benefit, you're getting 3.3. So the difference between the 3.3 and the 1.2 million is roughly 2 million rand. It's 2.1, but I'm calling it 2 million rand. You could then go and buy life cover for 2 million rand, and effectively, upon your death, untimely death, the 2 million rand will perhaps be paid to your spouse in scenario two, and so you haven't really lost out. Now, you have to pay premiums for the 2 million rand, but we'll come back to that aspect in the presentation itself. So let us assume that you were deciding to resign from the fund. In my example, the 3.3 million, From there, to establish what will be taxable. Remember the pre-98, which was tax-free. In this example, it was 900,000. That leaves you with a taxable amount of 2.4 million rand. And then we look into the tax tables, and with the tax payable, for this particular withdrawal, in this instance, would be 617,000. So you'll arrive at a net retirement payout of 2.683 million, and let's call it 2.7 million. You have paid 617,000 in taxes. You've lost that amount to your retirement, and this is perhaps not the way to go. So what should you be doing? Now listen very carefully, because this is the important part of saving taxes. You can still resign from the GEPF if it suits you and transfer to what we would call a preservation pension fund. The first step is resign from the GEPF. So you're taking your 3.3 million rand in my example, you're transferred to a pension preservation fund, and from there make one withdrawal immediately. So 1/3 of 3.3 million rand equals 1.1 million rand. You would take that 1.1 million rand tax-free and move it to your personal bank account. You would then be left in the preservation fund with 2.2 million rand. The second step, which you can do almost immediately, in a couple of days after you've taken out your 1.1 million and moved it to your personal bank account, you can take a further 1/3 of the 2.2 million rand, and that equates to approximately 750,000. So the cash portion that you can withdraw from the preservation fund will be 1.850 million rands, which is really made up of the 1.1 in step 1 plus the 750,000 rand in step 2. So, but remember that the tax-free portion is only an amount of 1.450 million rand. So how do I get that? That is a 900,000 rand, which is in our example, the pre-1998 tax-free amount that this person had, plus the normal tax-free retirement in terms of the Income Tax Act, which is now 550,000. So that gives you a 1,450,000. So really looking at that figure of 1,450,000 rand, and then taking it back to the cash portion that may be withdrawn, which is 1,850,000, it would not be advisable to then withdraw the full 1,850 million rands, because you'll end up paying tax. And this is how cleverly we play a role to make sure that you don't take out the taxable portion. So you can take an additional 350,000 and move the 350,000 to your personal bank account. So in your personalized bank account, you will now have the 1.1 million rand in step 1, and you're only taking out 350 instead of the amount of 750,000. So you now have a total of 1,450,000 rand in your personalized bank account. This amount is tax-free, and you can invest that money most tax efficiently. Again, we play a role in trying to work this, which is the best investment for you, both from a tax point of view, and also look and scouting around with the financial institutions to give you the best possible rate. The third step is what you're left with in your preservation fund will be an amount of 1,850,000 rand. Now that is there to help you to generate income. And you can invest that money of 1,850,000 rand either in a life annuity or a living annuity, or a combination of a life and a living annuity. So you're going to invest the 1,850 million rand in a life annuity to pay for your monthly lifestyle expenses, which really represents your salary in a normal situation. And the rest will then be invested in what we call a living annuity to grow for you to counter the effects of inflation in a diversified portfolio. So what we're really doing here is, by investing in both a life and a living annuity, we're trying to make sure that we're giving you the maximum returns on your investments, at the same time making it very tax efficient. Now, from the living annuity, there is an option to draw between 2.5% and 17.5% of the capital that you have in the actual living annuity. So you only pay tax on the amount that you draw. So if you're only drawing 2.5%, which is the minimum that you can draw, you'll pay tax on what you're drawing. And you're not paying tax on the amount that is left in the fund. If the fund is growing at, let's say, 10%, then the impact of that, the additional 7.5%, will continue to grow within the living annuity and will help you in your future years of retirement tax-free. Consider investing in what we call a hybrid annuity comprising of both a life and a living annuity, and which is the best of both worlds. Now, we at Garage Corporation will help you to make that decision. The types of GEPF payouts, both in the case of retirement and resignation, as indicated earlier, normal retirement is age 60. So if you retire at age 60, that would be considered as normal retirement. If you decide to retire before the age of 60, then in other words, between the ages of 55 and 60, there is a penalty of 0.33% that is applied per month, which is equal to 4% per year. So if you decide to retire exactly at the age of 55, you're going to pay a penalty for 5 years. 5 times 4%. 5 times this 4% gives you 20%. So you'll erode 20% of your capital amount, which is a fairly substantial amount of money, but you need to do your calculations. If you decide to retire over the age of 60, then no penalties will apply to you. So clearly will apply to you. So you would then receive that lump sum as together with monthly pension during your retirement phase of your life. You could, if you're over the age of 60, you can also make use of the resignation benefit that I've highlighted already. In the case of the resignation benefit, in that instance, clearly you will receive the actual lump sum. What are the tax implications of the retirement benefits? The GEPF benefits accrued before 1 March 1998 are tax-free. The GEPF benefits accrued after 1 March 1998 are actually taxable. They've leveled the playing field from March 1998, both in the case of private and state-owned funds for retirement purposes. The first 550,000 of retirement resignation lump sum is in actual fact tax-free, provided you're making use of the preservation fund, although you're resigning from the fund, is considered as a retirement. Remainder of the lump sum is taxed by the retirement tables, sliding scale commencing 18% up to 36%. The GEPF monthly pension is taxed as a normal salary. Who is the spouse upon the death of the pensioner? It is the husband, the wife, or the permanent life partner. When does the spouse receive the pension? Only after the death of the pensioner, who is the member. The monthly pension to the spouse, the first, normally what happens is for the rest of his or her life, the monthly pension will be paid to the spouse of the pensioner. How much would the spouse receive? The spouse will receive either an amount of 50% or 75% of the member's pension at the date of death, depends upon which option the pensioner took on at the time of his or her retirement. Do members receive inflationary increases during retirement? Yes, they do. Not always, but certainly on a yearly basis, they do get these increases. On the 1st of April 2023, the increase was more or less equated to inflation, which was 5.5%. GEPF payout on retirement, it depends on the years of service. If you have less than 10 years of service with the GEPF, then the lump sum gratuity equals the actuarial interest. If you have more than 10 years of service, then you normally get a lump sum gratuity upon retirement as well as a monthly pension, but you can opt to resign from the fund and get the entire lump sum paid out to you. When will you choose retirement instead of resignation for GEPF? When you, for example, may need the medical aid subsidy, which the government is providing, because perhaps your husband or wife or your spouse is not on medical aid, and you have been all along on the medical aid. Capped leave benefits matter to you. You may be carrying a lot of capped leave, and you need to take advantage of it. You don't get that when you resign from the GEPF. Your health is good. You can take out life cover for the 72% of retirement benefits. In our example, remember, in our earlier example, and I can go back to that example, there it is there. You can see the resignation benefit is 3.3 million. If you retire, the lump sum amount you receive is 1.2. So roughly, there seems to be an amount of about 2 million rand, which is a shortfall if you decide to retire and then you subsequently die. So we try and cover that amount in the form of a life cover. And I think what is important to understand that the monthly income in the GEPF retirement is generally between 9 and 10%. That is what the kind of return that you would get from a retirement from the GEPF, whilst a resignation on average will give you 7+%. So there is what we call an arbitrage or a difference between the two, and perhaps that difference can be used, the extra amount that you're receiving can be used to fund a life premium, which you're going to buy as a result of you retiring from the fund, and the shortfall then can be paid to your spouse. So certainly that's some consideration that you need to take into account whether you should retire or resign. Now, if you decide to resign from the fund, you would then have to generate your own income during your retirement as well as manage your retirement funds during your lifetime. You would then invest the money either in what we would call in two products. One is a life annuity with a capital guarantee, and the other could be a living annuity. So those are the two products that are available. It is possible to combine these two products into what we call a hybrid product or a hybrid annuity, but I will firstly discuss these two products separately. You firstly have to cover yourself for your monthly lifestyle expenses, and you would ideally do that with a life annuity with a guarantee on the capital. Now, what does that mean? You would invest part of your lump sum and receive a monthly income. The income that you get monthly is guaranteed and is meant to cover your lifestyle expenses on a monthly basis. The income received is taxable. Upon the death, the capital is paid to the beneficiary you've nominated in terms of the life annuity. The capital is paid to that beneficiary totally tax-free. The capital and income is not subjected to any market fluctuations. It's a fixed amount. It can be inflation linked if you wish to. On the other hand, a living annuity, you invest a lump sum and you receive a monthly income. You pay tax only on the income you draw and not how the income grows within the fund. So you can draw between, then this is where the flexible part comes around. You can draw an income between a minimum of 2.5% up to a maximum of 17.5% per annum. You pay tax on what you draw, and the rest of it just remains within the living annuity, and it will grow tax-free within the fund. On death, the capital is paid to your beneficiaries. The capital paid is taxable, unlike the life annuity where it's received tax-free. The capital and income is subject to market fluctuations, unlike the life annuities, there's no guarantees. Now, therefore, we advise you to do a hybrid annuity, which is a combination of life and a living annuity. You make an informed choice. You select the best fit for you. Obviously, we assist in making sure that that fit best suits you as an individual. Now, upon divorce, the person who is getting divorced while being a member of the GEPF, so now in that case, you'll find that the spouse who is not a member of the GEPF is entitled to part of the pension. The type of marriage that you enter into is irrelevant, so whether you're married in community of property or by antenuptial contract, whether it's with the accrual or without the accrual, does not play a role. What plays a role is the amount as per the divorce order or settlement agreement. That is the amount that will be taken out of the GEPF. The spouse who is receiving the pension, in other words, from the GEPF member, in other words, the member who is part of the GEPF, the spouse who is receiving it is not the member. If that spouse decides to withdraw the cash, then certainly that amount taken from your pension would be taxable in the hands of the spouse as a resignation benefit. On the other hand, if that spouse decides to transfer to another approved retirement fund, there are no tax implications for that particular spouse. As far as the member is concerned, who is now saddled with this burden, with the actual debt, so the divorce debt It creates a hole against the member's retirement fund. The divorced debt is subjected to interest at the repo rate as set out by the South African Reserve Bank. The member must settle that debt either by a lump sum or by installments. At the exit of the member from the fund, any balance outstanding will be deducted at the time when the member exits. There has been an amendment to the rules in 2019 where they now no longer expect you to put money back into your pension fund. The member's pensionable service period is reduced. Remember that pensionable period plays an important role in determining the actual benefit that you will receive at the end. That they're reducing obviously the period and therefore you receive a lower amount. Medical aid subsidy. Can the members qualify for a medical aid subsidy after retirement? That depends on the member's years of pensionable service. If you have less than 15 years, once-off lump sum payment. If it's more than 15 years, then generally the benefit is a lifelong benefit for the member and the spouse. So that's the subsidy that you would receive for medical aid from the state. Advice on my retirement. Now, what must I consider? Should it be early retirement, or must it be normal retirement, or should it be resignation? That's an important aspect that you need to consider. How much will I receive? Is my retirement package tax efficient? Where do I invest my money? How do I get monthly income to cover my monthly lifestyle expenses? How do I create wealth to protect me from inflation? Whether I want to set up a business or seek employment opportunities? Remember that these days people are living much longer, so you have to get along with life, and you may decide that you want to set up a business or work again. Securing the future for my family and myself is important. Living a stress-free retirement. Now, what are the important considerations before you decide to plunge into retirement? You have to settle all the debts that you have, the home loan, the motor vehicle finance, the overdraft, and so on. Provide for commitments. Could be some home repairs. You may need to buy a new car. Your children may perhaps still be at university and you need to provide for them. Review your existing insurance and investments. Is the life cover sufficient? Is medical aid adequate? Determine monthly lifestyle expenses. Determine the family income. Both spouses may be working, and now one spouse decides to retire. Consider alternate employment or business. Determine investment amount. Split that investment amount between tax-efficient monthly income, tax-efficient growth investment. Avoid tax by using a preservation fund or a retirement annuity. So these are important considerations. Now, who is going to help me to retire? And some of the important issues that you have to consider is who will prepare a personalized financial and retirement planning report. Check the calculations of my benefits, and I can assure you that over the years we picked up a number of errors, especially when it goes against the member himself. Advise me on various investments. Facilitate my investments. Advise me on income tax and estate duty implications of my investments. Complete my income tax return. And remember, you still have to complete your tax returns even during your retirement. Prepare my will. Draw up my trust if I have to. Manage my investments. Advise me on money matters. Review my portfolio annually. We at Garage Corporation is a multidisciplinary practice with professionals who will answer all your questions. Now, just to consider what you should be doing as far as your will is concerned, it's very important that you do draw up a will as you go into the retirement phase of your life. So we have a startling statistic in South Africa. 75% of South Africans do not have a valid will. Now, what does that mean? And the emphasis is obviously on the word valid. Many people try and draw up their own wills, but those wills are not valid because the requirements of the Wills Act is pretty stringent, and you have to follow those requirements. So you need to go to a professional to draft a will. So if you die with a valid will, then your estate will devolve as per the instructions in your will. But on the other hand, if you die without a valid will, then clearly what happens is that your estate is devolved according to the laws of interstate succession. These rules are very inflexible and very rigid, and therefore it is not advisable that you have to follow the Interstate Succession Act to wind up your estate. So therefore, it's important that you have a valid will. Now, this is very important. This was a recent clip from the Sunday Times, the 15th of October 2023, where transform the financial services sector, the GEPF is going to use its 2.7 trillion rands to drive change. I think this is a very important point that you need to consider. We often read statements in the press of government running out of funds. The last thing you want is for government to use your retirement funds towards any of its projects. Your retirement funds is your money, and you should be in full control of your hard-earned retirement money, and not for others to decide on how your money should be invested. I think that this is terribly important. You don't want somebody else to decide what happens to your retirement. Now, frequently asked questions, we often these questions are asked, and so I decided to cover the most frequently asked questions separately, and I'm going to have a look at these questions now. The GEPF is a pension fund. What does this mean when I retire? It means that upon retirement, you can only draw a certain lump sum, which equates approximately, in most cases, 28% of the value of your retirement amount, and the remainder of approximately 72% of the value of your retirement amount will be reinvested by the GEPF to give you monthly retirement income for the rest of your life. There is a pension guarantee for a period of 5 years from the date of your retirement, but generally upon your death, your spouse will receive a portion of your retirement income, and upon your spouse's death, the pension lump sum falls away and gets absorbed into the GEPF. Your family will not receive any further benefits after the death of both you and your spouse, and it certainly is something that you need to consider. What happens if I decide to resign from the GEPF? You will receive 100% of your resignation benefit, which you could invest to provide you with a retirement income. In order to avoid any tax penalties, you may invest the full resignation benefit in a preservation pension fund, and thereafter seek to invest your resignation benefits in a life and or a living annuity. It is important to note that you are in full control of 100% of your retirement funds, and that is important. What is a preservation pension fund? A preservation pension fund is a parking vehicle for retirement money. You have the option to transfer 100% of your resignation benefit into a preservation pension fund. It is held in this fund on a temporary basis, awaiting to be reinvested. Accumulating growth in the preservation fund is tax-free. You may make one withdrawal from the preservation fund to maximize on the tax-free portion and thereafter retire from the preservation fund altogether. I think that this is an important point, that you would be able to make out of your preservation fund generally two separate withdrawals. One would be in the case of the withdrawal benefit to maximize the tax-free portion, and then the second one would be a retirement benefit, again, another 1/3. So you need to do these calculations and make sure that the actual amount that you withdraw is a maximum tax-free amount. The rest of the money can then be invested in what is known a life or a living annuity. So what is a life annuity and what is a living annuity, and how do they work in the case of resignation from the GEPF? A life annuity guarantees you an income for the rest of your life, and you may include a guarantee on the capital upon your death. On the other hand, a living annuity offers you flexible income with the opportunity to grow the capital with distinct tax advantages, which benefits you and your family. These two forms of investments may be combined to give you a hybrid annuity, which will offer you optimal guarantees on the capital and the maximum tax benefits, so that your retirement funds last you a lifetime, both for you, your spouse, and your family. What is most important is that both retirement and resignation comes with its own benefits and challenges. You have the option to choose what is best for you and your family. No one option fits all. Your personal circumstances will determine your option. Why has the resignation values of members fallen after 1 November 2022? In the case of resignation, the benefit is reflected as a lump sum. It is calculated actuarially, which takes into account a number of assumptions, which includes, amongst others, the assets of the funds at any given time, salary increases of active members, and the expected long-term returns on monies on monies the fund invests. Based on the latest actual valuation, a lower capital is required to fund members' pension payouts during retirement. Hence, the value of the resignation benefits has fallen. If you have any further questions, please do not hesitate to contact one of our retirement planning consultants. There are many frequently asked questions. The firm has set out these questions and answers in a document which is available on request, together with other brochures on planning your retirement. You may get that from the email address, which I will chat to you later in the presentation. Now, we as Garage Corporation are a multidisciplinary firm. We have chartered accountants, we have lawyers, certified financial planners, tax practitioners, business rescue practitioners. All of these professionals in one team, in one firm, under one roof, discussing your retirement matters. The service offering from our firm is tax, accounting, business advisory, insurance, investments, wills, trusts, deceased estate administration, business rescue. We have offices in Durban and in Johannesburg, and the information furnished for you there are our contact details. You may have further questions. We're happy to entertain those questions. However, it's important for us to point out that you may contact our firm where you could obtain brochures and frequently asked questions on GEPF, and these can be obtained by mailing ashina@garach.co.za. It's ashina@garach.co.za. Offices both in Durban and Johannesburg, and those are our contact details. Thank you very much.